get the show on the road. Let's get the show on the road. All right, here we go. We got Jeff Mackey, Paul Meeks, Charlie Peabody, and Kevin Baker. They call him Bakes. We got to get going here. We got Paul Meeks on a schedule. What do you got, buddy?
So, Benjamin, I've been nibbling. Actually, I'll be specific about it. I bought some Uber yesterday at 62.35, and I have a limit order in to buy some more at 60 even. Looks like it's getting away from me. But here's the story with Uber. They really haven't had that much of a disappointment, though. Since the fall, the stock has gone down a third from 90 to 60. And it's based on the narrative, which I think has now become the consensus narrative, that they are going to be, not just Uber, but Lyft, the rideshare companies, are going to be disintermediated by autonomous driving. It was particularly nasty when Waymo announced that they're going from their key test markets and entering the Miami, Florida market. That got Uber in a death spiral. In the meantime, they reported a quarter, not perfect, but it never is. And in the last 90 days for this quarter, the consensus estimate for Uber has gone from about 49 cents to 48. So it's not a fundamental issue. The quarter that they reported was not a blow up in the magnitude of a 1/3 drop in the stock price. First of all, I don't think autonomous driving is going to be a commercial monetizable thing for a lot longer than the bulls expect. That's one. Second, I actually think they are going to embrace the rideshare companies, particularly Uber, that already has a relationship with Waymo, because I think Waymo is going to get their way before Tesla. And they're going to have levering each other's skills. And so I don't necessarily never agreed with the thesis that Uber was going to be taken to the woodshed to zero by autonomous driving. I actually think that they're going to figure out some way to work together. In the meantime, the stock is cheap, and then I put my technical hat on. I'm going to lean on Bakes on this like I always do. I was waiting for $60 to be the trough in the stock and then actually hold that area for a while, which it did the last couple of weeks of 24. And so I said, okay, I'm at least going to see some support at 60. So that's why when it bounced off 60 on a bullish Goldman report yesterday with almost a 100 target price, then I acted. I may go back depending on what Bakes has to say. And right now I got the last tranche in at a 62 even buy limit. Bakes, if you think that's not going to happen at this point, then I'll probably raise it. But what say you?
I use my sell discipline, which I encourage our subscribers to our members to take a look at. And this would be a sell to me. It closed below the 200-day back in July. The 200-day started going down in December. The 50-day crossed at the end of December. And if I'm going through the chart books all the time, I would say I'll go to other gin joints and not this one. And I think the autonomous driving noise is noise. But I'm just going to add, so I wouldn't touch this. I think you can get a trade from 60 to 70, but tell me what gets it above 75.40 to turn this trend around.
We'll have to see them report a solid quarter and give a forecast for the next quarter that isn't so dire as people expect. But you're absolutely right, Bakes. Since the narrative is totally based on the future or not of autonomous driving, I'm not going to be able to flip a switch and say, oh, the risk is off Uber. Because the people that believe autonomous driving, particularly pumped by Elon Musk, will say, oh, yeah, it's coming. Yeah, we'll see.
Well, I've been in a Waymo autonomous driving, and actually it's here. I think it's going to be a big deal. I still think they're going to need Uber. I think it's just, it's Uber's not a car company, and Waymo is not going to be able to interface with customers that way. Why would they reinvent the wheel on that? That's, having ridden around in the actual vehicles themselves, they're mind-blowing when they work. I'm not sure what the experience is in places outside of Scottsdale because I haven't flown around the country intentionally flying these things. It flips the switch. They're a better way. That being said, the idea that Tesla's just going to roll in there with these vans, they're hardly even trying. I think that's a legacy of Elon's little run that he's had since the election. I like Uber here. I agree in terms of fundamentals. You got to wait for it. The chart's a train wreck. You don't want a whole portfolio full of the Ubers of the world. But I think you got to buy them when you can on some of these names that get a little overcooked on the upside and then have to digest for a while.
So let me ask you
Yeah,
this
you
thing,
guys
Jeff,
know
because well, just
Sorry,
real
Ben.
quick, I want to throw this to the group. Is recently downloaded Lyft and I got to LAX on the 30th, and Lyft was 20% off for my next 10 rides. And I've heard they've been heavily discounted in San Francisco as well. And so you just wonder, is that near term hurting them, that supply overhang? And then also, because your initial reaction is like, oh, I want a short Lyft, because let's go back to Best Buy in Circuit City or Borders Books and Barnes and Noble. What tends to happen when you have a secular negative is that the weaker player is the one that goes out, and that part of the supply is taken out first. Now, Uber does trade at a large multiple, so you'd have to think through that. But there was a headline that came out yesterday, will Amazon buy Lyft? And I just wonder about that too, because Jeff is talking about, as we know, as a subscriber business, it's hard to gain mind share. It's hard to gain people to come on your app. Like, that part of the game is not easy. And now Waymo has one thing going for it, which is they have robot drivers. So there's a novelty aspect of that people, because here in LA, you see them all over the place. And you're like, it just doesn't look like a normal car. So you have a marketing aspect just to the car driving around. But I wonder if Lyft and Uber are buys. And I know Lyft is a train wreck even more so than Uber. But if you're trying to get to the consumer, is that something of value? What do you guys think about that?
I saw the Amazon headline, and it seemed like kind of a reach. It's having been involved with Peloton for a while, been involved with a lot of companies that Amazon was just about to buy any second now. Amazon's going to buy. Holy crap, here comes Amazon ready to buy. Amazon could expand into anything. I'm not sure that's necessarily their bailiwick. And I'm not necessarily anti-Lyft, but I agree with you, Ben. I'm inclined not to play number two in any of those type of spaces. And that's really your Uber thesis, right? Is it just what people pull out of their put it up on their phone and they get an Uber. They take an Uber and that's what they do. They've got that kind of halo that Google had, where Google was synonymous for years with just, this is how I'm going to look for something. I think that that trench is underestimated, and the ability to replicate it, rip it off, is way overestimated.
Amazon wants to jumpstart, pun intended, Zoox, which is way behind, of course, Waymo and Tesla at this point. So I wouldn't be surprised if they did something like that, but I think it would be, if they did join forces, may not be the ideal combination, right? Weak player merging with a weak player, but it would prove the thesis that these companies can or must coexist with the rideshare companies.
Do you think Uber will be around? Do you think Lyft will be around? Or do you think Lyft goes the way of Circuit City and Borders Books and the second player that tends to have a difficult time?
A year or two ago, I would have thought not. They did make a CEO change, and it looks like they're always going to be a weak sister, but the company is better managed now. And they actually went from a litany of missed quarters, and they've actually put a couple of decent quarters. Now, relative to expectations, not on an absolute basis, they have put those together. So I think they're better led now, stronger position. I imagine they stick around.
Okay. All right, let's move on. Jeff, what do you got for us today, bud?
I'm buying Gap. Yeah, I'm doing kind of beginning of the year. Let's look at some of the stuff that's just been hanging out and not doing much lately. We saw really just a huge run. We've talked about it a lot, Ben, in the consumer discretionary right after the election. Those stocks have been taking the month off or so, which makes sense as we get into chugging through Christmas. And over the next couple of weeks, we're going to see a lot of results from these companies, or at least pre-announcements. I think Gap is a pretty good candidate for a pre-announcement. They have really conservative earning estimates, which we're talking low double digits PE for next year is pretty cheap for a company like Gap. I love the way they're just turning their comps around. And in terms of the retailers that are not executing super well, these guys have the most kind of levers they can pull. It's 40% online, so mall traffic's not a problem for them. The new CEO is getting into his prime. He's been there about 2.5 years now. The normal rule of thumb for me is just bringing almost any fresh blood into a situation as screwed up as Gap was for so many years. When you get about a year before the guy actually has to produce anything, which worked as an investment for the Gap. Now, the real magic and the real Yahtzee there is when the CEO who comes in as a savior actually goes about saving some stuff. And what Gap, they hired from within at that top level for so many years that you forgot how many different things they can pull, how many stores they have that they can close, and they can lever off that. There are opportunities just to make Athleta less of a shit show and actually go after the athleisure market. I think Gap is going to be able to draft off the Vuori later on this year. They're going to come out with an IPO. That's going to be the high-end stuff. And you've got $70 billion of athleisure money available that's being split between all these high-end companies. It's people that are not super rich people. They like tights too. Athleta has been such an afterthought for so long. That's something that Gap can do well. And frankly, that's just what Dixon's preaching in terms of we got to execute every single day. It's about time Gap got back to that. Gap spent 20 years thinking they were still cool. They haven't been cool since Winona Ryder was in the ads, who love Winona. But that was a long time ago. So I'm sorry. It's a Gen X thing. We can't. It's just
yeah, she was pretty good in the new Beetlejuice, though, I have to say.
Oh, she's a national treasure, underrated national treasure. But I digress.
Even when she got caught shoplifting.
Yeah, I liked her more. I liked her more just because he's naughty, bad. All of that notwithstanding, Gap's been naughty real bad for the last 20 odd years. I think this is going to be a breakout year for him. And not necessarily a breakout, but I think he got 50% upside, maybe $5-6 downside. Tops on this, given how cheap it is, and given the fact that unless the consumer just flat out dies, there's a conservatism built into this model. It's not a place where people lined up all day. I also like Abercrombie and Fitch, which is a place where people were lined up all day. It's trading at 15 times earnings, but spent last year mostly in the penalty box after an explosive January. But Gap has more of a base going for it. I think we're just going to chill out here in the very low 20s and just build a platform. I'm not sure when it happens over the course of this year, but I really love the way they're set up here. A little bit of execution could go a long way, give you a pretty decent shot up to those 2021 kind of post-pandemic highs.
So you're thinking like 28, 29, 30? Like
I'm thinking it gets into the 30s. I think we can get at least into the 30s. I mean, there's a lot of room for multiple expansion. There has not been any for pretty logical reasons because they haven't been able to get their divisions going. This quarter is likely going to be the first time that all their divisions are going to comp positive for the first time in forever. Old Navy is really the straw that stirs the drink along with Gap brand, but they can make Banana Republic work a little bit. Athleta, again, is the huge wild card just because that's a really big opportunity in athleisure that just has done nothing, has never enjoyed 1 second of buzz, has never earned 1 second of buzz. I've seen literally people lining up to get into a Lululemon, standing in front of Athleta, selling largely tights. We're both selling tights, and Athleta can't give them away. Lululemon's charging $120 for them. That's telling. That's starting to change a little bit just as they find their customer. Old Navy's expanding out of just being a denim dumpster into clean stores that respect people. It can go a long way with that as well. Again, there's just a lot of stuff that a good CEO can do. And that's where they are now. It's after throwing long balls with, we're going to let Yeezy design all our product. We're going to hire from within and get back to when we were sexy and hot. No, you're not. You're going to be the Gap. You're going to be a nice basics company and a nice 15, 20 PE. That's good enough to get me to 36.
Okay. 36. Wow. That's a call. Gap.
That's a call.
We're going back to the original specialty retailer with our man, Mr. Retail, Jeff Mackey. All right. Like now let's go to our local bank analyst. How are they going to finance all those athleisure Gap purchases? And what else you got for us, Charlie? Oh, I think you're on mute.
I'm going to talk about new car sales because they'll be coming out over the course of today. We previewed this on Monday and said this may be the last hurrah of good news, and suggested being on the short side of some of these independent car dealers like Carvana, AutoNation, and CarMax. But today we will get new car sales over the course of the day. They're supposed to be strong. I think we're going to finish the year somewhere around 15.8, 15.9 million units sold. Jen, if you can put up the first table, I have a table showing some of the new car data. The third column shows the sales through November, excluding fleet sales, and we're running over 1.1 million, and we probably should do as good as that, if not better, here in December. But the key here is what's going on in order to get these cars moved off the lots. And when you're thinking about car sales, particularly new car sales, there are four variables you have to think about: wages, loan rates, incentives, and car prices. And we know wages right now are moving in the right direction. Loan rates for new cars are just under 9%, and they're remaining sticky. They haven't come down with the Fed cut in rates. And it's largely because delinquencies and repos are going up in this industry. Delinquencies today are higher than they were pre-pandemic. And in order to absorb that cost of higher losses, the dealers are keeping their loan rates high. And so we're not seeing much budge there. Incentives, I don't know if we have that next chart. Before we go to the next chart, sorry, Jen, if you can go back to the table. I'm sorry. If you can go back to the table. The first column of the table shows inventory. And you can see that inventory is building on the lots. And that's something as a bank analyst I hear from my banks is that floor plan loans or the utilization rates on floor plan being the cars on the lot that have to be financed as inventory. You can see that inventory is rising. And I hear from all my banks that the drawdowns on these utilization rates for floor plan is increasing. So that's another indication that while sales are healthy, the inventory on the lots continues to build. And you can see that in the first column. The way you move that, and now you can go to the next chart, the way you move that metal off the lot is with incentives and or lowering your car price. And they've been unwilling to lower their car price, but essentially they're doing it through incentives. So this shows that sort of brownish, yellowish line is the incentives. They bottomed in fall to around 2% of the average ticket price, which is the blue line. And are now, that's 7.7, they're up to 8% this month. So incentives have been rising very consistently in order to move cars off the lot. So at some point, that if we've had a pull forward effect on the volume on the sales side, and we're still needing to increase incentives to move cars off the lot, you're going to see gross margins get hurt and disappointments in the earnings. So I'm a believer that these auto sales companies, independent companies need to be shorted here. I've been saying that since September. It's as part of my broader theme of things that need to be financed are going to disappoint. These stocks, the AutoNation, the CarMax, the Carvanas, have held up much better than the home builders like D.R. Horton or Lennar, or the boat sellers like Polaris or Brunswick, or the RV sellers like Winnebago. Those all have succumbed to the I've been espousing. The auto companies have not, and unless you're an OEM, Stellantis and Volkswagen are flat on their back, but these other ones have not. So I think it's their turn now as we move into the new year. So I just wanted to re-highlight that theme and some of the numbers behind it. Then, if we have time, I'd just like to mention the Fed balance sheet, because earlier this week, and I think I posted my piece on Wall Street Beats yesterday morning, I wrote a piece last Sunday about the fragility of the funding system, and we're seeing signs that liquidity is starting to tighten and funding is becoming expensive for the banking system. The Fed filed their balance sheet every Thursday night after the close, and last night there were two things that caught my eye. The first was that bank excess reserves fell below $3 trillion for the first time since November of 2020. And the importance of that is the Fed wants to keep bank reserves somewhere above $2.5 trillion. And it's been floating above $3 trillion for a while now. And this is the first drop below $3 trillion that we've seen in many years. So it's significant. And the reason those numbers are cited, the $2.5 trillion, is the Fed believes in an ample reserve monetary system that you have to have reserves equal to somewhere around 7 to 8% of GDP. So if GDP is running around 29 trillion, then you want excess reserves in the banking system somewhere between 2 and 2.5 billion. And we dropped quite rapidly last week. Now, I went back and looked at 23. I went back and looked at 24 in terms of year end, and there was nothing that suggested that this was seasonal. And because that was my first thought, is it might be seasonal, but we didn't get the same kind of drops at year end in 23 or in 22 and 23. So it does suggest that the system is being drained of liquidity. So the reason this is important is the second thing that caught my eye is if you look at what we call primary credit, which is discount window borrowings by the banking system, they jumped as well last week, where it suggested that somebody or some group of banks are having to use the discount window to supplement their liquidity needs. And more importantly, you can only borrow from under what is called the primary credit facility for 90 days. Then after 90 days, if you still need to borrow from the Fed, it goes into what we call secondary credit. We saw a very slight, and I want to emphasize, very slight blip up in secondary credit last week as well, which says that somebody's been borrowing for more than 90 days from the Fed and now has to go to a second facility. And in that second facility, your collateral gets haircut a lot more. And it suggests, you don't want to borrow from in secondary credit. So it suggests there is a bank out there that's experiencing some liquidity problems. And I think that's very significant. So I do think the system is fragile. I think there have been a number of adjustments that the Fed has been trying to make to relieve this year-end seasonal pressure on rates, but it's not working. And that's very concerning to me. The recommendation out of this, I had mentioned back in December that I wanted to fade Bitcoin and buy gold. And I thought January would be the key period and when gold would take off. And if these funding pressures and excess liquidity being drained from the system are starting to hurt, then the Fed's going to have to quit QT much earlier than expected. People thought the Fed would end QT somewhere in the spring. They may have to end QT much more quickly. And that raises the question of, are they giving on inflation? And I think gold plays well in that. That's what I wanted to highlight on the Fed balance sheet.
Yeah, I'm with you. I think that the SOFR rates, and we talked about in the last show, are going to go a lot lower. If you look what's going on around the world, the dollar is just running over people like Saquon Barkley. And, basically...
He's a non-player.
We got to keep it light.
Marshall's not on the show, so you don't need that. You don't need to pander.
I was actually already letting them know how the Packers are going to come and beat them in the week one, just like the 2010 Super Bowl run. So I'm already on it. But back to the dollar and the Fed. Basically, the dollar is destroying FX around the world, and both domestic, developed, and emerging. And U.S. investors tend to not pay attention that much out of it because we have our little Atlantis where, you just don't have to think about it. But the rest of the world does have to think about it. And if you look at global dollar liquidity, dollar supply, it's going down. And so that's going to drag rates down. And I don't think the Fed's going to care about inflation. I think the long end will care about inflation. And you'll just see the curve steepener, as we've talked about. And that's been working quite well. The question will be then will a dollar weaker be what eventually pops the bubble for U.S. assets? Because, you look at any chart, foreign allocations to the U.S. are at all-time highs, and the equity market's about 45% foreign owned. That's quite a bit. It doesn't take a lot of that to pull out of it. As we've seen, it doesn't take much at these levels, like we've seen over the last 4 days. I've read it 4 red days in a row, the worst end and beginning of a market since 1952. So I think that you're on the right, that liquidity is being drained, and then eventually they're going to have to do something. And maybe that's what Bitcoin's seeing. But gold, priced in other currencies, is trading very well. The dollar is masking gold, and people are just sitting to consolidate. But that's what you want. We talked about gold in the fall, and I've been a huge gold bull on this show since we've started this company. But no one's talking about gold right now. And some of the gold miners, silver miners, actually had some breakouts yesterday. So I'm with you there. I think that's something people should look at. I think we'll move on to bakes.
Ben, one thing I want to support on your stronger dollar thesis and the problems that it's creating. On the Fed balance sheet, there's something called central bank liquidity swaps. And this is a way for our central bank to help other central banks around the world gain dollars, which they then give to the wards of their country, such as their local banks. And those central bank liquidity swaps did jump 2 weeks ago, and I wrote about this last Sunday. And then in addition to that, the Fed issued SDRs, the Treasury issued SDRs to the Fed in return for dollars. Those dollars were put in the Exchange Stabilization Fund, the ESF fund, and that fund is used to help stabilize currencies. So there is a dollar problem developing out there. There's no question. There's a shortage of dollars, and that's creating some pressure on overnight funding rates as well.
And also, just to continue on this real quick, is that auto stuff is starting to come forefront, that some of these auto loans are not performing. We know the CMBS, especially in office, is at the GFC levels of delinquencies right now. So there's a huge amount of stress there. That's not new information, but it just keeps getting worse. And so you have collateral damage all over the place, and in treasuries themselves, with the long end continuing to not come down as the Fed cuts. I think that as the BTFP, and maybe you can we can finish with this, BTFP comes off in March, right? And that's about $100 billion of like swaps, just like how we give central bank swaps, which was created in 2008 as a way, that was really what arrested the '08 crisis, is when they created the central bank swaps and got money dollars out to other central banks. What do you think about that as we loom about 2 months from now, we're facing that? And I think the market will start paying more and more attention to that as every day in the Q1 we go forward.
Yeah, Ben, sorry, the BTFP program is largely run down already. I think it's less than 10 billion now.
Oh, wow. I hadn't noticed that. Okay. Then that's on fact.
Hey guys, for those of us that don't have PhD in economics, what is that acronym, please?
Bank Term Funding Program.
Thank you.
This was a program that was put in place when Silicon Valley failed, and it allowed you to bring your treasury securities, which were underwater at that time, and pledge them as 100% collateral to shore up your liquidity. Because you couldn't sell your treasuries because they were underwater, but you could take them to the Fed and they'd give you 100 cents on the dollar.
Got it.
For the 95 cents. They took 500 bips haircut.
Not on BTFP, on treasuries.
We can talk about this offline. It's fine.
But that program only had a year of maturity to it when it was in place. And so Ben's absolutely right. In March, it'll go to zero. But it's largely been run down right now, which is why you're starting to see these discount window borrowings from some of these institutions that were using that program to shore up their liquidity.
Right. That makes sense. That makes sense completely. All right. So basic takeaway is liquidity keeps draining, both from a strong dollar, from underperforming assets, collateral, and then the stubbornness of inflation isn't allowing the rates market to go lower for people. There is definitely rising issues on the horizon here. Okay, Kevin, what do you got, buddy?
January is going to be a very tough month because some of these programs that the Fed put in place to get us through year end, they're going to start to go away by the middle of January. And if these funding pressures don't recede, then I think we're going to have a very ugly January.
Yeah, and just again, to go back to my view, is that you just buy the D25 or D26 SOFR futures, and they're both not around 96. And you think about that as just a discounted dollar. And if the world's short dollars, and that's what you have when you have a dollar rally, then why not buy short duration dollars on the discount? And that's the valve that they'll have to use in order to ease things. And yeah, inflation. But I think to the point about gold, to tie this all together, is that they're going to not care about inflation. Like they're going to view that as not as important as the banking system, as they always do.
Yeah. I mean, we're setting up for. Go ahead, Kevin.
Yeah, let's just move on. We could talk about this more, and we could talk about this for hours, Charlie. I think these two guys are like, come on, let's talk about some stocks. All right, what do you got, Kevin?
I'm buying Agnico Eagle, AEM. I'm buying Ashanti Gold, AU. So there are stocks there to be bought.
Yep.
And there's stocks to be sold like AutoNation, CarMax. Go ahead, Bakes. Sorry.
There you go.
From yesterday, I had technical difficulties, so I couldn't finish this. My voice has been going down an octave a day with my illness. But for the gas and oil conversation yesterday, which I really wanted to participate in, gas is better than oil. And I've been talking about CRK, Comstock Resources. That's acted way better than the oil-heavy Devons of the world. And I think Bob is adding to natural gas as there's a cold snap, but I also think that there's a flow issue. Everybody on CNBC that underperformed last year, which is almost all of them, they all say, I don't own NVIDIA because it's too expensive for me, but I think energy is going to finally have a run, and maybe it will happen sometime. I'm starting to think we're getting there. So that's one thing. Jim, pull up my chart here, please, the UAE chart. And for our members and potential members, I'm a little crazy. I'm the chartist, and I go through every ETF out there, and I'm just looking for changes in trend, both positively and negatively. And this is United Arab Emirates, UAE. This is the MSCI UAE ETF from BlackRock. It's a decent-sized ETF, $40 million. It's a clear breakout on clear volumes. So things in the UAE are getting better. Full disclosure, disclosure, I haven't pulled the trigger yet. I'll tell members later, bring them back in and say, hey, because I have a very specific buy discipline that I will share with members. So I buy within 5% of the breakout point, and I don't chase things, and I limit losses, and I let my winners run. This is $40 million. It trades $1 million a day. Here are the top 10 holdings, Jen, if you can add those. And I was surprised. I expected this to be the energy fund. And I go, Dan, do I need to own 40% energy in a part of the world that I couldn't find on a map? Listen, it's energy's 5% of the ETF. They're doing what Saudi Arabia is doing. They're diversifying their economy very adroitly, from what I understand. Financials are 37%. Real estate is 22%. Communications 16%. The PE is 10. So for the Martians of the world, they'll think I'm a wild-eyed growth guy that, no valuation is too high for me. Have that at price to book is 1.5, and there are no ADRs for any of these stocks. So if you want to buy them, you got to buy them. It's easier to buy them through the ETF. You can, but I think UAE is very interesting, and I'll let you know when I pull the trigger. But these are the kind of things that I don't see anybody on CNBC talking about. We talk about Wall Street Beats for our members, and we talk our book, and we'll tell you when we're right and when we're wrong. So that's it. Any questions, guys?
I like energy as a theme, Bakes. I think you're spot on here.
Yeah, I like it. I don't see the whites of their eyes. I think a lot of people, it's like you hit a golf shot and you lean because you want your ball to be in the fairway or the first cut, but the ball's going to do what the ball's going to do. If I wait to see a stripe down the fairway shot where the market has told me there's a change coming or is occurring right now in energy. We started like CRK, we saw it. My YPF in the Argentina ETF has been acting great forever. So I'm starting to come around. But I hate having dead money while I'm waiting around to be right and arguing with the market and tell the kids to get off my lawn. So that's just my thing.
Bakes, in terms of the individual members of that ETF, are the financials leading the whole ETF? Is there a way of looking at individual names, or they don't trade?
I don't have. There are no ADRs, so I haven't. The charts that I can get for UAE stocks don't dazzle me. I'm going to go through that all, but collectively, this looks like Argentina when I bought it a year and a half ago. I'm making that up, something like that. When chainsaws come out, I get interested, and when VCs and venture capitals get on podcasts and talk about going to UAE to find incredible investments that they're encouraging, I get interested. So I'll come back with individual charts on those stocks, but I don't have them right now.
The reason I was asking is because financials tend to be very good early cycle stocks, and they lead you out of a recession or into an expansion. And so if there's an expansion coming, energy may follow. Is that like a logical path?
Yeah, and Brent is just starting to perk its head up. If you're a member, you saw Ben's chart the other day. It's just starting to inflect. It isn't confirmed. I don't see confirmation yet, but my ears perk up and my eyebrows raise when I start seeing positive change, especially this time of the year where people are saying, hey, if I want to keep my job and have the Philadelphia pipe fitters stay with me, I've got to find the next NVIDIA, or I've got to find the next group that gets me to outperform so my 1, 3, and 5 year numbers don't make people sick. And we'll see. But I'm very interested. Jen, I know we're running late. Go to the next chart, please. My Fred chart. There we go. And I wish Marston was on because I like making the veins on his forehead go up a little bit. Ben and I have been talking about Doges for real, and almost everybody says, it's not going to happen. K Street's so strong. They're not going to cut anything. This is the interest expense, just the interest expense. And it's gone from 600 to 1.2 in the last 4 years. I don't care what side of the aisle you're on. That can't happen, and it can't be sustained. So anytime people complain, oh my God, you're going to cut Big Bird. Yeah, Big Bird. We can't afford Big Bird because of this interest expense. And this is going to be the political cover. And then what I think happens is we're going to start seeing story after story that goes through social media and through podcasts of absurd examples of waste, fraud, and abuse that no one's going to be able to defend. And we're going to see programs cut left and right. Now, people can argue with me. The Grace Commission, back here at 84, interest expense was hardly an issue. The Grace Commission didn't do much. I think this is because I've listened to Vivek and Elon for the past 18 months on all these different podcasts, and this series is a heart attack. And I think we have the window, all three branches of government, and we'll see what happens. But I think it's for real. And the reason I say this, that I believe that, here's my next chart. And this is Ben Bray's great short. Okay, if you remember, Ben, right after the election, short of this at 185 some odd. I'm making that number up, but we're close. 28% in about 5 weeks or less. And this is Booz Allen. This is a consulting company. They get 95% of their revenues from the federal government. And that has been great forever. That is going to change. And the market is telling me that it is changing right now. That is a breakdown. That is high volume. That is people saying, you know what? I'm going to go elsewhere because these guys are finally going to get put on a diet. And it's happening. And I see this in ELME, the Washington REIT. I see it in the General Dynamics and the Lockheed Martins. So this is happening, folks. And we've been talking about it forever. And if you work at these companies or you own these stocks in size, we've been telling you this, and get the heck out of the way. That's it. I'm done.
The only thing I would say and push back a little, and I don't know, I sent this chart to Jen, I just put it together, is you don't want to look at the nominal dollars of what an expense line is because the money supply is expanded over time. What you want to do is you want to compare it to GDP, right? So what percentage? And we're still not at the levels we were at in the late 70s, early 80s. But yeah, we're at 4%. It got up to 5 and change percent. And so I think we're fine, but we just need to course correct a little bit. But I will say this, as the Treasury Secretary lowered the duration by 1.25 years of the Treasury's outstandings over the last 2 years, we're very heavy on bills. And so we just cut 100 basis points out of bills in the last, 4 months. And I think the market's not saying this, but B. Bry is, and that is that rates will keep going lower. And that will help with that as well. And I think the interesting is they talk about it a lot, but I think it's actually worse for Carvanas and for the other parts. It comes back to what I talked about earlier about the secondary player lift. You want to think about who's the weak player at the table. And the weak players are the guys who are going to get hit because the government's going to get its money. You can count on that. And so even if whatever the rates are, and so you're just going to say, hey, this might crowd out. And to go back to Charlie's theme that he's been talking about for a long time, you need to get financed. So if you're in the private sector and you need to get financing, it's going to be harder and harder. And if you're running a leveraged book and you need to refinance, it's going to be harder and harder. So I think that's the bigger takeaway rather than just the government can't sustain this. That would be my point on this. Whether they do it or not, I think that's speculative. I think that it's underestimated, the probability of it, but it is a very tight majority in the Congress right now. So it's not, though they have a 30-seat lead or something, they only got a couple. And we'll see today, by the way, at noon, they're going to have the Speaker of the House vote. And we'll see, I think that'll be a good litmus test for what they're going to be able to get done. And so that's at noon Eastern. And so I'd take a look at that. And I'll leave you guys with that. So thanks for joining. This is Wall Street Beats. I'm Ben Bry. Once again with Jeff Mackey, Charlie Peabody, Kevin Baker. See you guys tomorrow. Or Monday, sorry.
Have a good weekend.
Keep smiling.
Have a good weekend. Thanks, Ben. Thanks, Jen.
Thanks, Ben.
Thanks, guys.